Let's talk about something you do pretty much every single day, spending money. But what if I told you that with almost every purchase, you're paying a kind of hidden tax? Today, I'm going to be your guide, and we're going to pull back the curtain on the incredibly complex financial machine that powers every single transaction you make.
Okay, so let's really get into this. Just picture it. You're at your local coffee shop. You tap your card to pay. It takes what, maybe a second? But in that single instant, you've kicked off a chain of events that is way more complex and frankly a whole lot more profitable for the banks than most of us ever imagine.
You see, with every swipe, every tap, or every online click, you are paying a tiny invisible toll. And when you add those tolls up across billions and billions of transactions, you're fueling one of the most sophisticated and lucrative industries on the entire planet. So here's the plan. We'll start with just how big this invisible toll is. Then we'll dissect the engine that drives it all, something called the interchange fee. After that, we'll look at other ways banks make money, uncover the real truth behind your rewards points, explain a law that totally changed your debit card, and finally, show you how you can use all of this knowledge to your own advantage. All right, first up, let's just try to get a handle on the sheer scale we're talking about here. This entire system is built on the massive, massive volume of our everyday spending. 157 billion. That's how many times Americans use something other than cash just last year. Think about that. And behind every single one of those payments is a carefully engineered financial system that is designed from the ground up to extract value at each and every step.
Now, at the very heart of that system is a mechanism most people have never even heard of. But trust me, it's the single most important concept to understand if you want to know how banks really profit from your spending. It's called the interchange fee.
So, what is it? Well, when you use your card, your bank, the one that issued you the card, charges the merchant's bank a fee, basically for the convenience and the risk of processing that payment. This little fee, it's the engine that powers the entire U.S. payments industry. And believe me, it is a massive engine. Just a couple of years ago, U.S. banks collected around $100 billion from these fees alone. This is exactly why banks fight so hard, with all those ads and offers, to get their specific credit card into your wallet. Now, what's really fascinating is how much this fee changes depending on the card you pull out. On a $100 purchase, a simple debit card might earn your bank just 26 cents. But that fancy premium rewards credit card, that one earns the bank $2.50. That is nearly 10 times more. And this right here perfectly explains why small businesses often prefer debit or cash. That fee comes directly out of their bottom line. But that incredibly powerful interchange engine is really just the beginning. As we're about to see, banks have developed this multi-layered system of other profit centers that are just woven right into your financial life. You know, long before interchange fees were even a thing, banks made money the old-fashioned way, lending. And that ancient business model is more profitable today than ever. Right now, Americans are carrying about $1 trillion in credit card debt that just rolls over from month to month. And with interest rates so high, that debt generates over $200 billion in interest for the banks every single year. And then, of course, you have the direct fees. So think of me as your advisor here. This is your checklist of what to watch out for. Overdraft fees can still hit you for around $35. Using the wrong ATM can cost you nearly $5. A late payment, that can trigger a fee of up to $41, not to mention a penalty interest rate. All of these are specifically designed to generate revenue. Let's just quickly demystify the most common one, the overdraft. It's actually a super simple 4-step process. First, your balance is low. Second, a transaction comes through that's bigger than what you have. Third, the bank decides to cover it for you. And fourth, for providing that service, they charge you that pretty hefty fee. Knowing these steps is really the key to avoiding it in the first place. Okay, so this brings us to a really fascinating paradox, the whole world of rewards programs. I mean, if banks are making money from all these fees, how can they possibly afford to give you cash back and airline miles? Where's that money coming from? Let's get really specific with the question. The absolute best interchange rates are somewhere around 2.5%. So how on earth can a bank offer you, say, a promotional rate of 5% cash back on groceries and still make any money? It seems like it shouldn't be possible, right? Well, the math is actually quite clever. So here it is. Here's the answer. The biggest piece of the pie that funds all those rewards programs? It isn't the interchange fee. It's the interest paid by customers who carry a balance from one month to the next. So here's the crucial point. The rewards that people who pay their bills in full every month enjoy are largely subsidized by the interest paid by those who don't. The rest is made up from interchange, those high annual fees, and the fact that a ton of points are never even redeemed. The industry has a name for that. They call it breakage. Now, if you've ever found yourself wondering why the rewards on your debit card suddenly vanished, or why it's so hard to find a truly free checking account anymore, the answer lies in a single piece of legislation that was passed back in 2010. So before 2010, the big banks made about 44 cents every single time you swiped your debit card. It was a sweet deal. Then something called the Durbin Amendment came along and basically slashed that fee almost in half for the country's biggest banks. And their response was, well, swift and predictable. With a huge revenue stream suddenly cut, they pulled back on perks like free checking and debit card rewards, and they started pushing their much more profitable credit cards on everybody instead. But here's the really key takeaway for you. This law created a two-tiered system. Big banks, those with over $10 billion in assets, they have to follow the new lower fee cap. But smaller community banks and credit unions, they're exempt. This is exactly why you can often find better debit rewards or genuinely free checking at a local credit union. Their debit card transactions are just still more profitable for them. Okay, so let's tie all of this together. We've looked at the fees, the interest models, the regulations. The final step is to really understand what this all means for you and how you can actually use this knowledge as leverage. First, it's really important to get that the US has one of the most expensive payment systems in the entire developed world. I mean, here in the States, those interchange fees can climb as high as 2.5%. In Europe, on the other hand, they're legally capped at just 0.3%. That is a huge difference. And who do you think pays for that difference? We do. Merchants just bake those high processing costs right into the prices of everything they sell. And that means that every single consumer, including people who pay with cash, is effectively subsidizing this incredibly expensive system and helping to fund the rewards programs for credit card users. It's like a hidden tax on everything you buy. And really, that brings us to the most important takeaway from this whole thing. Understanding this system isn't about being cynical. It's just about being smart. When you understand the economics behind it all, you can choose a credit union that has better terms. You know why paying off your credit card balance every month is so critical, and you can recognize when a fee is totally avoidable. Look, the financial system is designed with extraordinary care to be profitable. It is not an accident, it is a machine. But now you can see how that machine actually works. So the real question is, armed with this knowledge, how will you navigate it differently